Eswar S. Prasad, The Future of Money, How the Digital Revolution is Transforming Currencies and Finance. Welcome to the fascinating world of The Future of Money, where Eswar S. Prasad unravels the ongoing transformation of currencies and finance due to the digital revolution. In this book summary, you'll explore the role of cryptocurrencies, fintech breakthroughs, and the rise of central bank digital currencies, CBDCs. Learn about the intriguing impact of companies like Ant Group and digital payment platforms such as M-Pesa, which are changing the way people transact and banks operate. As you delve into these game-changing developments, you'll discover how governments and traditional financial institutions are being challenged, forcing them to adapt and innovate in this new financial landscape.
Digital currencies and the future of money. The rise of digital currencies, spurred on by the launch of Bitcoin in 2009, has accelerated the disruption in finance. The cashless future is no longer confined to Nordic nations and China, as central banks and treasuries across the world are experimenting with digital currencies. The Bahamas recently launched a government-backed digital currency in 2020, pointing to a future where paper money could disappear by 2030. While Bitcoin's value has been volatile, its promise of an era of efficient, frictionless payment systems has not gone unnoticed. Tech giants such as Facebook and Amazon are experimenting with alternative currencies, while Alibaba's Ant Group has been aggressively expanding into the financial market. The world of money is undergoing a revolutionary change, and digital currencies could be at the forefront of this shift towards a cashless society. The rise of central bank digital currencies. Central bank digital currencies, CBDCs, are gaining popularity worldwide as nations explore new ways to maintain control over monetary policy while preventing tax evasion and crime. CBDCs will replace fiat currency, which is vulnerable to inflation caused by irresponsible governance. Sweden's central bank, Riksbank, and China are already researching CBDCs known as e-krona and electronic currency, respectively. By being more monitored and regulated than cash, governments can eradicate tax evasion and criminal activities. The trend is evident, and it is clear that cash is on the way out. Fintech revolutionizing the financial industry. In countries where mobile phones are pervasive, fintech platforms have revolutionized the way people perform transactions. M-Pesa, a banking service launched by Kenya's largest mobile phone company in 2007, has proven to be hugely popular among Kenyans, allowing them to pay for services quickly and easily from their phones. Fintech firms such as Chime, N26, and Lending Club have also been gathering momentum in the United States and Europe, attracting millions of customers through lower costs and broader access to financial services. The success of these platforms has put pressure on mainstream financial services providers to adapt, with major brokerage firms forced to slash commissions to zero. The fintech model promises to bring less affluent consumers into the mainstream of financial services and has the potential to change the financial industry as we know it. The rise and limitations of Bitcoin. In the midst of the 2008 financial crisis, Satoshi Nakamoto introduced the concept of Bitcoin as a decentralized form of currency that relies on cryptography instead of trust in central banks or commercial institutions. Over the years, Bitcoin has gained popularity and value, spawning numerous imitators and coming to be seen as digital gold. Bitcoins are created through a process called mining, which involves solving cryptographic puzzles that become increasingly difficult to reward miners with bitcoins. The system is designed to limit the total supply of bitcoins to 21 million coins, and the remaining coins are not expected to be mined until 2140. However, this supply cap creates limitations for Bitcoin as a means of exchange due to the potential for a deflationary spiral. Despite this, the rise of Bitcoin has sparked interest in alternative currencies and the potential for a decentralized financial system. Bitcoin's pros and cons. Bitcoin's biggest accomplishment is its decentralization ability to create trust without government-backed currency. The blockchain network ensures secure transactions and eliminates the possibility of double spending and other fraud activities. However, Bitcoin's major flaws include its volatility and difficulty in spending. A reliable medium of exchange requires stable value, which Bitcoin lacks due to its history of soaring and crashing values. Additionally, the current transaction system is too clunky and slow, with the blockchain network taking almost 10 minutes to confirm a transaction and processing only 7 transactions per second. Despite these limitations, Bitcoin's innovation creates a new way of conducting transactions, and the currency's value is constantly reassessed by its users. Bitcoin's anonymity and risks. Bitcoin's veil of anonymity is not entirely secure as every transaction is public, allowing authorities to trace scammers. Bitcoin's lack of support has led to many owners losing their coins, and there is no remedy for lost passwords. Bitcoin was initially attractive to many due to its veil of anonymity, which presented a vast range of opportunities. However, that illusion of privacy has been shattered as every Bitcoin transaction is public, which means authorities can track down scammers relatively quickly. In 2020, a Florida teenager ran a scam on Twitter, and it brought in $180,000. Federal agents caught the perpetrator, showcasing how authorities can link scammers to transactions. Additionally, Bitcoin lacks a support network, leaving many coin owners powerless to retrieve their stash. One drug dealer claimed to have lost over $60 million in Bitcoins after his landlord threw away the paper on which he had written his passwords. Another saga was that of a Canadian cryptocurrency exchange CEO who died suddenly at the age of 30 and was the only person who knew passwords that protected $250 million worth of Bitcoins. Bitcoin's system offers no remedy for those who forget or lose their security keys or passwords. In conclusion, Bitcoin's attitudes range from fanatical believers to intense skeptics, but the cryptocurrency's veil of anonymity is not bulletproof as every transaction is public. Additionally, Bitcoin's lack of support network has led to millions of dollars worth of lost coins, leaving owners with no remedy for lost passwords. Ethereum and the rise of alternative cryptocurrencies. Bitcoin's limitations gave rise to alternative cryptocurrencies like Ethereum, which became the second most valuable virtual coin worth $300 billion as of May 2021. Ethereum differed from Bitcoin by utilizing the Ethereum blockchain, where initial coin offerings, ICOs, proliferated, and stablecoins, a type of currency tied to an underlying commodity or fiat currency, emerged as another innovation. The announcement of Facebook's cryptocurrency, Libra, in 2018 was met with swift and forceful pushback from regulatory bodies. Bank of England Governor Mark Carney stated that Facebook couldn't expect a free pass as it had with its social network and that it would need proper regulation and oversight. Facebook reworked its plans for Libra amidst the attention shifting to the pandemic, but alternative cryptocurrencies continue to thrive. The risks of unregulated financial innovation. As financial innovation booms, non-bank institutions are rising in importance. Regulators are struggling to keep up, and new players like China's Ant Group are falling through the cracks, posing systemic risks. The collapse of fintech giant Wirecard AG highlights the dangers of unchecked growth. If governments continue to rely on regulated banks, they may be unable to respond to moments of volatility and uncertainty. The global economy needs smarter, tailored regulatory systems that can adapt to the relentlessly changing financial landscape. The paradoxes of today's financial landscape. The economic landscape is changing rapidly, and with it come financial ironies. Central bank digital currencies will replace physical money, while fintechs gain momentum, and commercial banks lose their advantage. However, banks aren't in danger of disappearing anytime soon. With the rise of new technology and non-bank actors in financial regulation, the role of central banks is getting more complicated. Cash also presents a paradox, as physical money is untraceable and ideal for criminal activity, while cryptocurrencies were created to be exchanged but are too volatile to spend. Fiat currencies' elasticity of supply provides a solid foundation underlying their stability, in contrast to Bitcoin's value that repeatedly booms and busts.
In conclusion, the future of money takes you on a journey through the radical shift in finance, propelled by digital currencies and fintech advancements. While cryptocurrencies like Bitcoin have caused disruption, their volatility and limitations have led to the emergence of alternative solutions such as CBDCs and stablecoins. Fintech firms like M-Pesa and Chime are transforming banking services, pushing traditional banks to adapt and evolve. As we move towards a future where cash loses its dominance, central banks retain their significance despite an increasingly complex financial ecosystem. Embrace the paradoxes and intricacies of this new monetary age, as the digital revolution continues to reshape our understanding of money and finance.